Welcome to The Explainer. Today, we're diving deep into a major forecast for 2026, looking at both the U.S. economy and the housing market. So what's on the horizon, according to the data? Let's get into it. All right, here's our game plan. We're going to start with a big economic picture, then zoom right into the real estate market itself. After that, we'll talk about the potential risks, and then we'll wrap it all up with the single biggest takeaway you need to know. First things first, we've got to look at the foundation because, to really get a handle on where housing is headed, you have to check the pulse of the entire U.S. economy. Think of these as the economy's vital signs. We're going to touch on a few key ones, like GDP, that's the value of everything we produce, plus inflation and income. These are the ingredients that shape everything from the job market to how much your mortgage is going to cost you. Okay, what's really fascinating here is the journey we've been on. I mean, look at that huge dip in 2020 and then that massive rebound in 21. This forecast is basically telling us we're finally moving out of all that choppiness and into a period of more predictable, steady growth. And here's the one everybody's been watching: inflation. This chart shows a bit of a bumpy ride, but the trend is clearly downward. We're projected to get much closer to that magic 2% target the Fed is always talking about. And that, folks, is absolutely key for hopefully bringing down interest rates and just boosting your buying power. And that really is the delicate balancing act, right? It's like the Fed is trying to gently tap the brakes to get prices under control, but they can't push so hard that they stall the whole economic engine and send us into a recession. It's a really tricky maneuver. So here's the kicker. Whose income is actually growing? If you look at that top yellow line, that's the top 20% of households. It has just soared. Meanwhile, middle and lower incomes have grown way, way slower. This widening gap is a huge piece of the puzzle when we talk about who can and who can't afford to buy a home right now. So how does all this big economic stuff actually trickle down to the housing market? Let's take a look. This is where the rubber really meets the road. These are the core metrics. When you hear people talk about the housing market, these three numbers pretty much tell the whole story. How many homes are selling, what they're selling for, and how many are even available to begin with. After the absolute frenzy of the last few years, check out this projection. It's showing that the market is finding a new, more sustainable pace. We're not talking about a crash here, but a stabilization, a cool down. And this one brilliantly illustrates the new normal for prices. That curvy green line, that's the historical 4% growth trend. And as you can plainly see, prices are still way above it. So even though the rate of growth is slowing, the prices themselves are holding onto those massive gains from the pandemic boom. This timeline really puts it all into perspective, doesn't it? We've seen these wild cycles before, from the bubble in '05 to the crash in '09, and then that unbelievable 21% spike in 2022. The forecast for 2026? It brings us back to a much calmer 2% appreciation. It's a return to a more traditional market. Okay, now for that third key metric, inventory. This chart shows something called months of supply. And you'll notice it's still way below that dotted line, which would be a balanced market. So why should you care? Let's break down what months of supply actually means. It's actually pretty simple. If no new homes were listed for sale starting today, this is how long it would take to sell everything that's currently on the market. A healthy, balanced market has about 6 months of supply. And like we just saw, we're still below that. That means competition among buyers is still pretty high, and sellers, well, they tend to have the upper hand. So the market is stabilizing. Sounds pretty good, right? But it's not without some potential headwinds. We need to look at the risks that could change this whole forecast. The forecast flags a few key risks that could really disrupt this outlook, everything from policy changes to market corrections. Let's just touch on a couple of examples. So imagine you're trying to run a business, but the rules of the game, things like tariffs and major regulations, keep changing on you. It makes it incredibly hard to make long-term plans for hiring or investing, and that kind of uncertainty can slow down the entire economy. I mean, we've all seen the massive boom in AI stocks, but a lot of that investment is piled into just a handful of huge companies. If investors start to get nervous about long-term profits and a correction happens, that could send ripples well beyond the stock market and into the broader economy. And listen, these risks aren't just abstract ideas. If inflation suddenly spikes again, mortgage rates could go right back up, making homes less affordable. And conflicts happening around the globe, they can easily disrupt supply chains, which means the prices you pay for everyday goods could be affected right here at home.
Okay, so we've looked at the big economy, we've drilled down into the housing market, and we've weighed the risks. Now let's just distill this all down into the one core idea you should really walk away with.
So, after sifting through all this data, what's the final word? What does this vision for 2026 really look like when you put it all together? And there it is. The key phrase here is a market in transition. We are moving away from the extreme highs and lows and into a new phase of normalization. The market is stabilizing, but it's not set in stone. The key to the future is going to be how we navigate all this economic uncertainty on the horizon. So the big question remains, will this transition be a soft landing or a bumpy ride?